Welcome back to the daily briefing for July 30th, 2026. Every single day, our AI screens the market for high-quality companies trading at unusually cheap valuations, and we accumulate those picks through steady dollar-cost averaging, while new names keep getting added to the list. U.S. markets have been grinding higher this summer, led by software and AI infrastructure names, though investors remain watchful of rate policy and stretched mega-cap valuations. That backdrop is leaving plenty of quality mid and large caps behind, which is exactly where our screener hunts. Today, the AI has flagged 5 stocks: Adobe, Autodesk, Insulet, Salesforce, and Workday.
Quick portfolio check-in. And it has been a strong month since we started accumulating on July 7th. PayPal leads the pack, up 29.4% with 23.3% of alpha over the S&P 500, followed by Workday, up 21.8% with 24.7% alpha. Adobe, up 20.8% with 23.7% alpha, and Autodesk, up 18.2% with 21.1% alpha. FactSet, added mid-July, is already up 11.7% with 14.6% alpha, while Viva has gained 8.3% and Insulet 6.8%, both comfortably ahead of the index. Our newest additions from yesterday, Salesforce and ServiceNow, are off to a quick start at plus 3.8% and plus 4.7% respectively. The only laggard is Netflix, down 3.1% and roughly flat against the S&P. So 9 of our 10 positions are beating the market.
Adobe is the creative software giant behind Photoshop, Premiere, and the Document Cloud, running a subscription empire with an 89% gross margin and a remarkable 70% return on invested capital. The stock still sits 28% below its high, in the cheapest 5% of its own valuation history, and offers a generous 8.8% free cash flow yield. Here is the mispricing. The market is pricing in essentially zero future growth, even though revenue has compounded at 10.5% and earnings just grew 57%. Estimate revisions and earnings beats have been trending positive as its AI features start converting into paid upgrades. The key risk is that generative AI tools eventually erode Adobe's creative moat rather than strengthen it.
Autodesk makes the design and engineering software behind much of the world's buildings, factories, and products, including AutoCAD and Revit, with a stellar 92% gross margin and a 51% return on invested capital. Shares are down about 25% from their peak and sit cheaper than 97% of their own valuation history. The market is only pricing in around 5% long-term growth, yet revenue has compounded at nearly 13% and earnings more than doubled this past year, a gap our reverse DCF flags as clear mispricing. Quarterly momentum and upward estimate revisions have supported the story as its subscription transition matures. The main risk is Autodesk's exposure to construction and manufacturing cycles, which could stall if the economy cools. Insulet makes the Omnipod, a tubeless wearable insulin pump that is winning over people with diabetes and driving an exceptional 28% revenue growth rate. The stock has been cut roughly in half, down 52% from its peak, and now trades cheaper than 97% of its own history despite earnings growing 89%. The market is pricing in about 19% growth, still below what the company has actually been delivering, and its 23% return on invested capital shows the growth is profitable. Recent quarters have featured consistent earnings beats and accelerating new customer starts. The key risk is the GLP-1 weight loss drug wave, which investors fear could shrink the long-term diabetes device market. Salesforce is the world's leading customer relationship management platform, the system big companies use to run their sales, service, and marketing teams. It now throws off a hefty 10.7% free cash flow yield, sits 29% below its high, and trades in the cheapest 5% of its valuation history. Remarkably, the market is pricing in negative 3% growth, effectively treating Salesforce as a dying business, even as earnings just grew 80% on aggressive margin expansion. Direction signals are constructive, with steady earnings beats and estimates inching higher as its AI agent products roll out. The risk is real, though. revenue growth has slowed to single digits, and AI-native competitors are coming after its core seat-based business model.
Workday provides the cloud software that large enterprises use for human resources and finance, a sticky business with a 76% gross margin. The stock is down 32% from its high, trades cheaper than 88% of its own history, and the market is pricing in barely 2% growth. That looks disconnected from reality, because revenue has compounded at 15% and earnings nearly quadrupled as the company pivoted hard toward profitability. Earnings beats and improving margins have driven a string of upward estimate revisions this year. The main risk is cautious enterprise IT spending, since large HR and finance software deals are often the first to be delayed in a slowdown.
That wraps up today's briefing. 5 quality compounders the market is pricing for far less growth than they keep delivering, and a portfolio where 9 of 10 positions are beating the S&P 500. Same time tomorrow, the AI will be back with fresh picks as we keep steadily accumulating. If you find these briefings useful, subscribing helps you follow the journey day by day. This video is auto-generated for personal record-keeping and is not financial advice. All investment decisions are your own responsibility.